Hi everybody, this is Gary Dean and this is our weekend video report for Sunday, August 28th, 2016. Hope you guys are having a fantastic weekend and let's get started. So Friday there was a lot of movement and it had to do with the with Yellen speaking at the summit, and that what happens with that is the algorithms are able to jerk things around, and what I mean by that is in the morning, for some reason the shorts have been, well, for some reason, we know the reason, they've been trained come Fed Day or any time that Yellen is going to be in front of the TV, you don't want to short because they press it up and then make people cover, and from there that's when it usually goes down. Well, they tried the same thing on Friday, and the S&P was up close to what do we got here? 72 up to 88, almost 16 points. And from there, we gave it all back again. Another gap up that failed. And every time they've done these, it's just failed. And this is the triangle that that was being first. There was, well, let me do this. This was the original triangle that I was talking about, and I said that this move right here is probably going to trap a lot of bulls because the target was all the way up at 22 like 10. So once we gapped above it, everybody was jumping in because the target was here. And just like every other gap up, it failed and came down. So we had a lot of trapped traders here. Now what happened with this, where we made the gap up here, what this has turned into, it turned into an ascending triangle where you can see it's flat right here, and then it was going up. So again, the way this pattern typically works is it then breaks out, and then this is the distance of the pattern right here. It would be from 2194 to 21, say, let's just say 64, so 30 points. So it'd be 30 points once it breaks above it. So these patterns that were in place were bullish, and they were getting a lot of people to buy up here. And then when we had the the gap up and we started going up on it, you can see that it just touched the bottom of this ascending triangle. So this is a bullish pattern that failed, came back up, touched the bottom trend line, and then from there we just collapsed. Now there still is, we were breaking through some important support levels, but they were able to push it right back up again, and we only closed down 3 points. But this is the 60-minute chart. And again, we have the 5 waves, so that leaves the door open for a pullback that would bring us anywhere to 2092 down to 2034. I've been saying that for a while. We have the bearish divergences. And right now, if we take a look at things where we closed, you can see that the 50-day moving average is starting to come down, and it's trading below both of them again for a second day. So this market's really, really tired. And really, the main thing the main takeaway that I've been trying to get across, because it's been really, really frustrating, because we've gone pretty much nowhere since for about a month. We've going down and going up, but ending up in the same place. So it's been really, really frustrating. But what I've been saying is that the larger point move is going to be to the downside. It's not going to be a breakaway move that just runs up to 2300. I'm sticking with that until it's until something proves it wrong. But you can see that every gap up and every try they've tried to make that run, it got sold off and came right back down. So we went below this level here, which was the 2168 level, and I said that's an important level, and if it does, we're probably going to get a reaction trade down to the 2146. Well, they brought it down to one of the pivots. It was also a little bit of support right in this area from here. So they bounced it. We're going back up. I think the 2174 is going to be difficult to get through because A, it's a pivot. it's the 200-day moving average on the 60-minute, and it's a whole bunch of resistance. So if they do get above it, there's probably going to be a reaction trade up to the 2180. So your pivot that we want to watch is 2174. If the bulls can get through it, then the next stop is going to be the 2180. If they get through that, then we're going to be testing these highs here at 2184. But you can see there's a lot of work that the bulls have to do here. So if the bears can push it through the lows that we made here on Friday, that's when we're probably going to get this reaction trade down to the 2146. And maybe they try to bounce it. If they lose that, then what happens is we're probably coming all the way down to this 2116 in a very, very fast manner. So that's pretty much it on it. There's no bullish divergences in place. We've been so overextended that even when this does become oversold, there's a good chance that it's going to actually turn into something like this, but reversed, where we continue lower, even though the technicals are going to be oversold. So that's the bears need to push it through the lows on Friday, which is that 2160. From there, we should get the reaction trade down to the 2146. And really the biggest concern that I would say, if I was just looking long this market, would be all these gaps that are that are below here, and they typically do get filled at some point. And what we've found or what we've seen in the past, is they get filled in a very, very fast manner, meaning a few days or 5 days, it just goes down and closes all these gaps. So the last gap here is all the way down at 2003, and what we have to remember is that it's still this bearish pattern that's in play, and this is the megaphone top that's in there. So we hit the top of it, and even though we made a higher high from here, you can see we never hit back above on this trend line here. So if this pattern is in play, which I don't know, we'll find out soon enough, that's calling for it to come at a minimum down to the bottom of this trend line here, which, depending on when it gets there, it's going to be somewhere down at the 1922 level in this area here. Now, if the pattern is actually in play, it would make this a bear ugly scenario, because the way that this works is you would take the 1991 and you go to the top here, which is I'm just going to keep it simple. So say it's 2191. So you have it's 200 points. That would be the distance of this pattern. And what that means is that if it came down and broke through this trend line, the pattern then goes another 200 points down from the bottom of this trend line. So it would be a huge move to the downside, because it would bring the S&P down to the 1700 level. But if we just take a look at things here on a daily chart, you can see that it's it would actually make sense, because it would only be a 38% retracement from the entire rally that started in 2009. So it wouldn't be crazy to see that type of pullback, but I'm not really, I'm not looking out that far. What I'm looking at right now is I would love to see the bottom of the trend line get hit, and from there, make a decision on what to do. But what we want to watch also is this 2144. So that's also where the support was here. Hang on one second. Let me do. I think it was 2143. So if we go to a daily chart, you can see that's where the 50-day moving average is as well. So we're probably going to find just some buyers there, because it's also some support that's here. So this is going to be what the bears have to push through. And if they do that, that's when I do believe we start seeing some panic in this market. And again, we'd probably come down to the 2052 in a really, really fast manner. But if, like I was just saying, we have gaps that are going all the way down to the down at the 1863. So there's a lot of open gaps, and what really the main thing is that this market's just not safe. Even if it grinds higher or goes sideways, it's very exhausted, and it's not a safe thing. And I do believe that the larger point move from here is going to be to the downside. So we have the bearish divergences, very overbought. We've been very overbought, and we haven't even really had a reset as far as on the technical end of things since January of this year. So it's been a while. It would make sense for it, and like I said, it could go a lot deeper than anybody is really anticipating right now. And the bulls have not really been tested, so they're not in shape to fight against any selling. And when that happens, usually they lose important support levels, and then people panic and everybody tries to sell at once. So let's see what plays out tomorrow. Again, what we really want to watch is the if the bulls can push it above this 2173, we're probably coming up to the 2180 and then the 2186. If the bears push it through to 2160, we're probably going to get the reaction trade down to the 2146, 2140 area. And that would be the next decision point. So let's see what plays out tomorrow. Enjoy the rest of your weekend and have a great night.